Welcome back to Pisopedia playlist. In the previous episode, we talked about personal finance and its importance in making informed financial decisions. We briefly mentioned investing, which we will dive deeper into with this video. If you haven't seen the last episode, we'll link it down below, so make sure to check it out. Now, let's do a quick recap. What does it mean to invest? Investing means committing a certain amount. You call this your capital to your chosen investment for a certain period of time with the promise that it will earn you a profit or gain in the end. We also mentioned last time that there are two common categories of investments: stocks or equity, where you purchase stakes at a company, and bonds or debt, where you lend money to the company. We mentioned the third option, funds. These are usually a mix of different assets professionally managed for you. Let's try to understand stocks and bonds even more. Why do companies allow you to purchase shares of their business? Why do they issue bonds? Both are ways for the company to raise money. Here, let me show you. So here's Company A. They sell shares. They've also been doing well as a business, so they're feeling good about potentially expanding. They want to add more share variations, open up another branch, maybe even introduce tables. But they'll need to raise some capital, as these changes will be expensive. Company A has a couple of options to raise that money. They can go to a bank and try to get a loan, or they can try to persuade a few investors. But let's just say they decided to issue stocks that investors can purchase in exchange for ownership shares in the company. With the money they get from these shares, they can go ahead with their expansion plans and eventually gain more profit. As an investor, this is great for you because this means the value of the company will appreciate. You might receive dividends from Company A, or you can eventually sell your share to another person for a higher price, earning you a profit.
Hello, I like money.
Now, we also have Company B. Company B is another furniture business that wants to raise funds in order to expand. Let's say that they are hesitant to go public, meaning they don't want to give up ownership through issued stocks. They decided to opt instead for loans. Company B can issue bonds, which is a piece of paper that serves as an agreement between them and their lender or the investor that the company will repay them with both the principal or the original amount borrowed and the interest according to the time period agreed upon. The interest is a key part of the agreement because as a lender, you're not only giving up the principal for a period of time, you also lose the opportunity to grow your money further during that time. So Company B needs to compensate you for that. Again, Company A and Company B are two very simple examples. In reality, these transactions occur at a much higher rate and volume. Now that we understand these options in the position of the company issuing them, let's put ourselves in the shoes of Bobby, the interested investor. Knowing that there are different investment options available, how exactly should Bobby decide where to put his money? Is there a better investment? The answer to this is simple. That it's not really that simple. Although investments do promise a return, it is important to remember that there will always be risks. After all, market conditions are difficult to predict. Before Bobby can decide where to invest, he needs to reflect on his financial goals first and the risk he is willing to take. There are different risk profiles. Some people are more risk averse. They'll want to take in less risks, but in return, they're also okay with receiving lower returns. They prioritize preservation of their capital. At the opposite end are risk-seeking investors. These are the individuals who are willing to take on more risk and uncertainty in exchange of the possibility of higher returns. Aside from Bobby's risk profile, another consideration in planning is how much time he's willing to commit to monitoring his assets. He could be an active investor who has a more hands-on approach with more frequent trades in trying to take advantage of short-term market changes. The goal is to beat the market. The opposite would be a passive investor who has a less proactive approach, leaving their investments to grow over a certain period of time with the goal of getting market returns. Once you've figured out your financial goals and the type of investor that you want to be, the next step would be to better understand the different investment options available. First, let's define what equities are. Equity represents the shareholder's stake in the company. For the company, this is equivalent to their liabilities minus assets, as it represents the value that would be returned to the shareholders if all of the company's assets were liquidated and all of its debt was paid off. There are 7 types of accounts that make up the equity of a company: common stock, preferred stock, additional paid-in capital, contributed surplus, retained earnings, other comprehensive income, and treasury stock. But before you go off investing in equities, first you must understand how they can earn you money. You can make money through 4 ways. First, dividends. Investors are entitled to a share of the company's profits. Second, buyback. A company may repurchase their stock from investors at a higher price than the market rate. Third, capital gains. If the market price of a stock increases, you can sell it for a higher price than when you bought it. This goes hand in hand with rights and bonus issues, where a company may provide discounts or give free shares to their existing shareholders. So now you know the basics of equities, but what exactly can you do with them? You can invest in them. An equity investment is money invested in a company by purchasing shares of that company in the stock market. So, going back to our example earlier, if Bobby decided to invest in Company A, he would have to become a shareholder before enjoying the benefits of partially owning the company. Once Company A achieves their sales goals and becomes more profitable, Bobby could receive dividends or even sell his stock at higher price, depending on the market perception. However, there are still risks that can affect equity investments, namely credit risk, a company's inability to pay its debt; foreign currency risk, a change in the company's value because of the shifts in international currencies; liquidity risk, a company's inability to meet its short-term debt obligations; political risk, where returns can suffer due to a country's political changes or instability; economic concentration risk, wherein the company's value drops because it's too concentrated in a single entity. In other words, when the company puts too many of their eggs in one basket. Lastly, inflation risk, which is when the company's worth gets diluted due to increasing inflation rates. Now that you're informed of the risks, let's discuss what to do next. Where can you, a prospective investor, find these securities? There are primary and secondary markets for you to find what stock aligns with your preferences. The primary market is where securities are created, while the secondary market is where securities are traded by investors. An example of the latter is the Philippine Stock Exchange, where traders are given a platform to transact with buyers and sellers. You can also purchase debt securities on the Philippine Dealing Exchange, where corporate bonds are traded. Congratulations! You're now equipped with basic equity investment knowledge. Challenge yourself, study the risks, and invest. Now that we know about equities, we turn to debt instruments. A debt instrument is an asset that an entity, such as an individual, business, or the government, uses to raise capital or to generate investment income. Examples are credit cards, credit lines, debentures, mortgages, loans, and bonds. One of the common debt instruments is a bond, which is a loan issued or sold by a borrower or the bond issuer and purchased by a lender or the bondholder. Bonds are usually issued either by the government or by companies who are in need of funds. There are 4 types of bonds according to issuer. Number 1, Treasury securities, which are issued by the Bureau of Treasury. Number 2, government bonds, which are issued by government agencies like Pag-ibig or the Home Development Mutual Fund. Number 3, municipal bonds, which are issued and announced by local governments. And lastly, we have corporate bonds, which are issued by large corporations. So let's take, for example, Company B. Company B needs to raise money to finance new projects, maintain ongoing operations, and refinance existing debts. To fund all of these, it decided to issue bonds directly to investors instead of obtaining loans from a bank. Bobby, as an investor, buys a portion of the bond and he becomes a bondholder. There are 2 ways Bobby can earn from this, either by trading or holding the bond. If Bobby decides on holding the bond, he simply earns from the interest payments until the maturity date. On the other hand, if Bobby decides to trade the bond, it means he can sell the bond before it reaches the maturity date. This means he can earn capital gains or losses after selling it. There are two main risks associated with these bonds. One is a default risk, wherein Company B may be unable to pay what is due, and Bobby loses a portion or all of his original investment. Second, we have the interest rate risk, where changes in market interest rates affect the value of your fixed payments. The main thing to remember here is that bond prices have an inverse relationship to interest rates. If interest rates go up, the bond becomes less valuable and its face value goes down. After knowing all of these about bonds, you may ask, how can I invest in it? Well, one is through the retail treasury bonds or RTBs, which you can purchase through your participating banks or through bonds.ph. You can also buy bonds from the secondary market through the Philippine Dealings and Exchange Corporation or PDEX. And lastly, you can purchase premium bonds via participating banks or through the treasury.gov.ph website. To summarize, let's have a quick review of what we've learned about equity and debt investments. Equity investments involve buying shareholder stakes in a company. You make money from stocks, from dividends, which are company profits distributed to shareholders, from companies buying back their stocks at a higher price, and from selling shares to other investors at a higher amount. Common types of equity instruments are common stocks and preferred stocks. Equity investments can be risky because of their volatile nature. Poor company performance or even bad news about a company might result in sharp drops in share value. If you want to invest in equity instruments, you can participate in the primary market by buying stocks directly from companies, or you can buy stocks from stock exchanges and brokers. Debt investment involves loaning money to individuals, businesses, or governments. You make money from debt investments from interest returns from the entity you lent money to. You can also sell bonds in the secondary market above face value. The common types of debt investments are treasury securities, government bonds, municipal bonds, and corporate bonds. The risks involved in debt investing are default risk or when an entity cannot pay back what they owe you. If you want to get into debt investing, you can buy retail treasury bonds from banks or bonds.ph, secondary market bonds from PDEX, or premium bonds from the government. Equity investments have a bigger potential for return, but with greater returns, you must also be prepared to take on greater risk. Debt investments are less volatile. They involve lower risk, so there's also a cap on its potential for returns. Its promise to repay your capital along with fixed interest payments make it more suitable for risk-averse investors. At the end of the day, there's no one best choice for investing. Choosing between debt and equity investments ultimately boils down to your personal finance goals and your motivation to invest. Equity is great if you want high returns and are willing to take more risks, but if you want a safer option, a debt investment might be a better fit. Debt and equity investments are the most conventional types of investments, but nowadays, they aren't your only options. All the innovations in finance and technology have pioneered new ways for you to invest and grow your money. If you want to learn more about those, make sure to tune in to the next episode of Piso Playlist. Thanks for watching.